Welcome to this explainer, where we're unpacking Linde's Q2 2026 earnings. If you follow the industrial gases and engineering sector at all, you're well aware that the current macroeconomic climate is, frankly, incredibly tough right now. Yet, Linde just posted numbers that are absolutely staggering. Today, we're going to tear down the engine of this performance, from their top-line revenue all the way down to their massive project backlog, to see exactly how they managed to pull off these record results. Here's our quick roadmap for today. First, we'll look at the record Q2 financial highlights. Then we'll break down their regional growth engines, followed by the engineering and project backlog, their cash flow and returns, and finally, their future outlook and guidance.
All right, Section 1. Record Q2 financial highlights. Let's start right at the top line to get a sense of the true scale of what they achieved this quarter.
$9.3 billion. That is a massive 9% year-over-year jump in total Q2 sales. But honestly, the real insight here is found in the mix. While favorable currency wins did give them about a 2% push, their underlying sales still grew by a very solid 4%. And they hit this perfect sweet spot, exactly 2% from higher pricing and 2% from volume growth. That volume, it's being heavily fueled by hungry demand in the electronics, manufacturing, and chemicals and energy end markets.
Now, bringing in revenue is great, right? But actually keeping it? That's the hard part. Despite crazy global cost inflation, Linde secured an industry-leading 29.5% adjusted operating margin. In the heavy industrial sector, margins usually get completely crushed when supply chain costs or raw materials spike. Yet Linde's aggressive productivity initiatives and super strategic pricing basically neutralize that inflation, driving a $2.7 billion adjusted operating profit. That's up 7% from last year.
And as you'd expect, all that top-line growth is translating beautifully to the bottom line. We're seeing double-digit growth across the board here. GAAP earnings per share jumped 11% to $4.15, and adjusted EPS jumped 10% to $4.50. The story is absolutely clear. Linde is taking top-line sales, maintaining ironclad margins, and turning them directly into real, substantial earnings growth for their shareholders.
Moving right along to Section 2, the regional growth engines. Because having a global footprint means you're navigating very different economic realities all at once.
Looking at the breakdown, the Americas segment is absolutely dominating the picture. It makes up nearly half of their total revenue at $4.08 billion. And much like the global picture we just talked about, underlying sales here grew by 4%, balanced perfectly evenly between price and volume, with electronics and manufacturing really leading the charge. Meanwhile, EMEA definitely held its own, generating $2.3 billion, APAC brought in $1.87 billion, and the engineering segment chipped in a very solid $625 million.
But here's the catch. While the Americas has the sheer size, Asia-Pacific has the speed. APAC is growing the fastest, boasting an impressive 13% year-over-year growth rate. Even if you strip away the extra noise, underlying sales in APAC are still up a massive 8%. Unlike the Americas, which relied on that even split, APAC's growth is heavily volume-driven. We're talking a 6% surge just from volume, thanks to the electronics and chemical sectors, plus a few key project startups. EMEA and the Americas, for comparison, both posted a very solid 7% overall growth.
Okay, Section 3, Engineering and Project Backlog. This is the really exciting part, where we see exactly how they're locking in their future revenue streams.
CEO Sanjeev Lamba basically credits this whole success story to pure, ruthless execution by his team. He highlighted a metric that really stands out to me, a 23.5% return on capital. That is just incredible efficiency. And customer proposal activity remains highly robust right now, especially in the electronic space, which gives management serious confidence moving forward, pretty much regardless of what the broader economic climate is doing.
And you know what backs up that confidence? A staggering $11 billion total project backlog. Just think about that number for a second. This isn't just speculative, maybe someday revenue. This is a locked-in pipeline of secured future growth projects. It basically acts as a massive financial shock absorber against any short-term economic turbulence.
A huge chunk of that total is a record $8.1 billion sale of gas backlog, which was recently supercharged by a major long-term electronics supply contract right here in the U.S. This is a massive takeaway for us. Linde is strategically aligning itself with the highest growth sectors out there. By locking in these long-term contracts to supply ultra-high purity and specialty gases for semiconductors, they are literally cementing themselves as an indispensable part of the global tech supply chain.
Let's jump into Section 4, Cash Flow and Returns.
Because revenue on paper is one thing, but actual, tangible cash generation is the true measure of a company's health.
Like we said, cash is king. In Q2, their operating cash flow grew by 3% year over year to hit nearly $2.3 billion. From there, they deployed over $1.4 billion into capital expenditures. Why? To build and maintain the massive infrastructure required for that $11 billion backlog we were just talking about. Yet, even after that incredibly heavy reinvestment back into the business, they still cleared $833 million in pure free cash flow.
And they aren't just sitting on it, they're putting that cash straight to work for their investors, returning a combined $1.59 billion through dividends and stock repurchases in this quarter alone. It's a very aggressive, shareholder-friendly strategy. They're successfully walking this crazy tightrope, pouring billions into infrastructure for future growth while simultaneously heavily rewarding their investors today with significant cash returns.
Finally, Section 5, Future Outlook and Guidance. Data from the past is helpful, but we really need to see how leadership views the road ahead.
Looking ahead, management is definitely not taking their foot off the gas. They're projecting continued strength, guiding for 8 to 9% adjusted EPS growth for the full year. That means they expect to land somewhere between $17.70 and $17.90 per share. And to support their ongoing maintenance and that massive contractual backlog, they anticipate full-year capital expenditures to hit up to $6 billion.
So here is the big question we're left with. Can Linde actually maintain this industry-leading profitability as the macro environment keeps shifting? Given their heavy reliance on the electronics and manufacturing sectors, this is the exact pivotal question investors will be asking as we await Q3. Management clearly believes their aggressive productivity, strategic pricing, and those locked-in projects will insulate them from volatility. And hey, a nearly 30% margin certainly proves it for now. But as global supply chains and inflation metrics continue to wobble, keeping a close eye on their margins and that APAC volume is going to be absolutely critical. Thanks so much for joining me for this explainer. We're definitely going to be watching closely to see what Linde does next.